Hey, there's a new risk player in terms of global crude oil, and you can give it the acronym SOH, Strait of Hormuz. Going forward, for the foreseeable future, every barrel of oil globally will be dealing with what we now call a new risk component. And that risk component should add somewhere between $15 and $25 a barrel to global oil. Don't care if it's West Texas Intermediate. Don't care if it's going to be Murbain. I don't care if it's going to be Iranian oil or Brazilian oil. In the entire global market, we now have a SOH risk factor. When you look at the largest concentration of production in the world, it comes out of the Middle East. And because of what the Iranian terrorists and the Republican Guard have done, is they show that any barrel of oil coming in that region can be touched, can be affected, and can be at risk. So now you have vessels, insurance companies, pipelines, aggregators, exploration companies. They're all going to look at this and say, in order for us to successfully develop and produce reserves anywhere in that region, it's going to be at least a $15 to $25 risk. That SOH risk component should add $15 to $25 a barrel. So today you have to ask yourself, at $83 a barrel this morning, have we factored in that $25 barrel risk? Have we factored in the low end of $15 a barrel risk? And the answer is no, we have not. We haven't factored it in because it hasn't become a reality. Someone has been waving a white flag saying that the Iranians are given. They've decided to sign an MOU, which they have not abided by from the day they signed it. Don't even know if the person that signed it had the authority. The game that's being played is the President of the United States is hopefully, wishfully thinking that maybe someone in Iran can make a decision that calls for a truce, a denuclearization, and help bring the Strait of Hormuz back to being open and free of any kind of terroristic threats. It's not going to happen anytime in the foreseeable future. So if you look at basically 20% of the world's supply coming out of the Middle East, and you now know that's at risk of being disrupted like it is today by 15 million barrels a day, you have to add in a 15% risk factor. So add in $15 to $25 to the price of oil. You should be somewhere around $93 to $110 a barrel today. $83 is not where oil is going to stay. $83 is simply where the traders have placed it based on this particular month cycle. When the players and the traders find out there's not enough physical barrels in the market to buy, they will pay whatever price they have to pay to get that physical barrel to the end consumer, the country, the refinery, whatever the final destination is. Today at $83 a barrel, I would imagine by the end of this month, we could be at somewhere around $92 to $97 a barrel if we don't cross $100 a barrel by the time we get to September 1st. If for some reason that trading makes it past this cycle, this month of traders trying to find physical barrels, I still believe we're at $125 a barrel by the end of the year. Because why? Because what we don't have is reality in the marketplace. What we have has been suppressed prices. When you add in the cost and the risk, we should be $15 to $25 higher than we are today right now. That's called reality.